Overall, the FTSE 100 lost about 10% in 2020. In 2021, it bounced back and beat all-time highs, and as at recording, this video has returned nearly 15% over the course of the year. However, we are interested in the future, not the past. And I believe that the UK has some pretty tasty looking dividend businesses at the moment that could make really good long-term plays. In this video, I am going to go over 5 businesses that could deliver well for those of you looking to invest in UK dividend businesses in 2022. These 5 businesses are diverse in terms of sector. They cover finance, pharma, consumer goods, raw materials, a lot. You've also got geographical diversification covered in terms of the fact that across these businesses, you have operations in most of the countries throughout the globe. So if you're UK based, you will also be avoiding any foreign exchange fees and withholding tax. So just in case you're not sure, withholding tax is a tax on any dividends you receive from businesses outside of the country you live in, and actually can significantly impact on your return. So it's important to manage them. So in certain circumstances, I would say that actually holding these businesses might be a great starting point for a UK based dividend portfolio. So of course, this is not advice and you must do your own research. So first up, and this is one I foolishly sold at the beginning of this year. It has since increased by 20%, and it is Lloyds Bank. So Lloyds Bank is a British retail and commercial bank. It's got branches across England and Wales, and it is traditionally considered to be one of the big 4 banks. So the others being HSBC, Barclays and NatWest. Lloyds Bank on the LSE then has a ticker of LLOY, and it's got a market cap currently of 35 billion quid. The share price is currently 49p, and as I mentioned, I sold it this year. Here's my holding, put a link here. So I sold it at 43p, a slight gain at the time, but I do regret selling it. It's since gone on to return 20%. The dividend rate is 1.16, so it is the second smallest dividend business in the list, and it actually cut its dividend last year completely. However, that doesn't worry me because it was forced to cut its dividend by the Bank of England, and it wasn't a decision made by Lloyds. It was taken out of their hands, and as soon as they were allowed, they reinstated it. It has a PE of 41, which might be a bit high at the moment. You can make your own mind up on that. But the top line financials, then we've got a revenue of 29 billion last year, which obviously was down versus the previous years, and we know why, and a profit to match at 1.2 billion. Prior to that, profits had been pretty steady for the last few years actually, but it's important to bear in mind with this one, 20% returns inside 12 months are not going to be a common theme, and this is yet another example of a business that would be really good to hold and dollar cost averaging to take advantage of all of those peaks and troughs. So the dividend is still way back on what it has been before, but I do predict some growth in that dividend over the next few years as that dividend stabilizes and they begin to contribute a bit more to it, to the investor. This is a business that I see will give some good stable dividend returns over the next few years. It's not going to set the portfolio on fire by any means, but could give some really nice growth over a number of years with reinvested dividends. By the way, if you're interested in investing in any of these businesses we mentioned today, I've got a link below. You can sign up for free trade where you can get a share up to the value of 200 quid for free. All you have to do is deposit £1. It also really helps support the channel, which of course I really genuinely appreciate. Second up, we've got Rio Tinto. So Rio Tinto is a FTSE 100 based multinational business, and it is the world's second largest metals and mining company. It's known for producing iron ore, copper, diamonds, gold and uranium, amongst a load of other different materials basically. It has mines and offices all over the world, and this is a business that is vital to so many different industries, from mobile phones, car manufacturing, medical, construction, and pretty much everything in between. So that for me is what makes it on the outset look like a pretty tasty proposition. So Rio Tinto has a ticker symbol of RIO. It's got a market cap of 76 billion and the share price is currently at 4,732p or £47 a share. However, it has had some considerable decline over the last 12 months, dropping 6% in the last year and 22% in the last 6 months alone at the time of recording. This, of course, has mainly been driven by global shortages of, well, pretty much everything, to be honest, from labor to chips to everything else. So could this decline represent a buying opportunity? Only you will know given your personal circumstances. Dividend at the moment is a juicy looking 7.2% and the PE ratio is really rather low at 8 currently. Now, obviously, both the dividend and the PE have been driven to those numbers by the decline in the share price. So you need to decide for yourself if you think that this could represent a good buy given those numbers. Let's have a look at the financials then, and I have to say that the last 5 years are looking pretty good for this one. The revenue is trending up quite a bit, from 33 billion 5 years ago to 44 billion last year. That's quite a significant growth in terms of revenue. That also shows that the business therefore must be somewhat recession proof, given that the revenue grew in 2020. There's not many businesses that are in this sort of sector that did that. Profit is equally impressive with some really good gains over the last few years. If this business can keep its dividend where it's at and continue with these numbers, and we see an improvement in 2022 of the shortages we've seen in 2021, then I can see the potential for some really good growth over the next few years with this one. Don't forget, if you take any value out of these videos, please do consider subscribing and give it a thumbs up, as you wouldn't believe how much it means to me and how much it helps this channel. So in at number 3, we've got National Grid. So National Grid, as the name might suggest, is a utility supplier, providing gas and electricity to the UK, but also to the northeast of the United States. Not many people know that. They also supply into the US. It is the largest investor-owned utility company in the world, and it is primarily listed on the London Stock Exchange, with a secondary listing on the New York Stock Exchange due to its supply into the US. So the London Stock Exchange listing then is ticker NG, and it has a market cap of 77 billion quid, and the share price is currently at 1,005 pence, or just over a tenner a share. The business has had a nice stable growth over the last year. However, longer term gains have been pretty stagnant, to be honest, with just a 9.7 return over the last 5 years. However, the dividend has not been bad and is currently a 4.89% yield. Now, don't forget, inflation at the moment is at the highest level in decades. At the moment, it's 4.2%. So that means for this business alone, most of the dividend is eroded away by inflation. So inflation, though, is not going to be that high forever, and investing into dividend business is about long-term gains. It's about reinvesting those dividends so that you start to get that snowball effect. But what I'm basically saying is, actually, for a long-term investor like I am, yes, inflation can be scary, but having a strategy that is in the decades rather than the months can mean that actually it pales into insignificance over time. So we've also got a PE ratio of 21.52, which is the second highest of all the businesses in this list. So worth bearing in mind too, whether you see this as a good value to buy into at the moment. So a quick look at the financials shows us that both revenue and profit have been pretty much static, with a slight decline, if we're honest, which will only be compounded by inflation, I'm afraid. So the elephant in the room with this business then is the sustainability credentials. So with COP26 just over the shoulder, the world is looking at businesses just like this to see what they are going to do to improve their environmental impact. And when you look at the website, they've got some group targets, and those are around net zero by 2050 and a 70% greenhouse gas emission reduction by 2030. And it's not easy for a business that sells gas to do those sort of things. So if you have faith that this business can deliver specifically against those sustainability targets, then it might make a good long-term play in 2022. In at number 4, we've got GlaxoSmithKline. So GSK is another global reach company. It's got head offices in the UK and therefore listed on the FTSE 100. It's the 6th largest pharma company in the world, but it's only actually been established since 2000, following a merger of Glaxo Wellcome and SmithKline Beecham. It is known for developing the world's first malaria vaccine. Again, don't think too many people know that, but nowadays manufactures all sorts of pharma-based products like over-the-counter medicines, vaccines, amongst a number of different products. GSK has a ticker of, well, you guessed it, GSK, and currently is a market cap of 77 billion, making it the largest company in the UK by market cap in this list. And if you've looked into the business recently, you'll see that the markets are certainly looking favorably on this company. It's up over the last few days nearly 10%, and a number of analysts have moved it to a buy rating. So the share price at the moment is 1,542 pence, or £15.40 a share, and as I mentioned, has been trending up recently, and in fact all year as well, to be honest. So the 1 year chart does look nice. That does follow 5 years of really pretty stagnant growth though, so bear that in mind. And we've got returns over 5 years at just 1%, not including dividends. So yes, it's had a good year, but the 5-year view is not quite so good. Speaking of dividends, it currently pays a rather healthy 5.19% yield, making it the second highest dividend payer on the list after Rio Tinto. PE ratio is at 13.28, so pretty fairly priced, if not good value at the moment. And looking at the financials then makes for lovely viewing. Revenue growing year on year over the last 5 years, from 27 billion in 2016 all the way up to 34 billion in 2020. Again, that shows a business that does well during a pandemic, but there's no surprises there for a pharmaceutical company. So profit looking nearly as good, going from 2.2 billion to 7.7 billion. So that represents nearly a 300% increase in profit over that period. Really good returns. So it looks to me to be a pretty good company to invest in for 2022 and beyond. A really nice long-term play, I would say. And last up, and this one is probably a bit more speculative and a bit more risky, so please do your research with this one. But last up is Auto Trader. So Auto Trader, for those living in a cave, is a British automotive classified advertising business. Basically, it's a website and an app where you can buy and sell cars, new cars, old cars, vans, bikes, buses, all sorts. Auto Trader then is listed on the London Stock Exchange as ticker AUTO, Auto. It has a market cap of just 7 billion quid, making it the smallest company on the list by quite a bit. But with smaller businesses, of course, comes more volatility, both up and down potentially. So looking at the 1 year chart for this business, you can see some very good returns. Yeah, 36% up over the year, with the majority of that coming in the last 6 months. And this has been driven by the increased demand for second-hand cars as a result of the global shortage of chips. We've got the smallest dividend of the lot at 0.68%, but that makes sense given the size of the business. You know, it's a growing business still. We also have a PE ratio of 55, so bear that in mind, whether that represents value to you at the moment or not, given the increase over the last few months. So over the last 5 years, both revenue and profit have been a bit all over the place, really. And in reality, both are down versus where they were 5 years ago, despite the stock actually returning 85% on share price over the same period. So this must mean that the markets have fancied this one. The world of second-hand cars is changing at the moment then with the advent of electric, and a lot of countries now saying that combustion engine production needs to be ceased by a certain amount of time in the future. And I see if companies like Autotrade can use this to their advantage, then they could have a bright future. I mean, the population is continuing to grow, and more people are continuing to need second-hand cars. But as I said, though, it is speculative and it is a riskier play, but this has had the best returns of everyone we have listed. But you must do your own research. Now, if you like UK dividend businesses, check this video out where I list my 2 favorites of the lot, 2 that I haven't actually listed here today. Thanks for watching.